Hello, everyone, for joining us. We're here for the Fireside Chat hosted by Madison Alley. And of course, we're delighted to have Sir Martin Sorrell here with us. We'll get started in just a moment. We have over 500 people that have registered for this event, and already we're having nearly 200 people that I see are coming online here. First and foremost, I just want to, of course, wish everyone well and hope everyone's safe and well in this moment. So we'll get started here. So Sir Martin, thanks very much for joining us. We're delighted to have you here, and particularly in this time of global crisis. Many of your experience and of course insight will be very valuable for many of the agency leaders and advertising and marketing tech leaders out there in this particular time. So thanks very much for that. As many of you know, Sir Martin has had a legendary career. Most recently, he's as of 2018, he founded and is executive chairman of S4 Capital. S4 Capital now, he's already built in about 2 years to 2,500 people in 30 countries and offers world-class creative production, data, and programmatic on a global scale. It's brands that many of you know are Media Monks and Mighty Hive. Last year, he's already accumulated or generated 215 million pounds of revenue, grew almost 300% growth versus the prior year. And on an organic or like-for-like basis is, on a pro forma basis, 37, on a like-for-like basis is just over 40%, with adjusted EBITDA of about 33 million pounds. Prior to S4 Capital, as many of you know, Sir Martin was founded and was the chief executive for 33 years of WPP, and as many of us know, built WPP into the world's largest advertising and marketing services company. Upon his departure in April 2018, WPP had a market cap of over 16 million pounds, a revenue of over 15 million pounds, which was 2017, EBITDA of 2.5 billion pounds, and he was leading 200,000 people, or the organization had 200,000 people in over 100 countries. And many of you know, of course, the brands within WPP, Ogilvy, Wonderman, AKQA, Grey Group, and many others that most of us are familiar with. So with that, again, Sir Martin, thanks very much for joining us. It's really a delight to have you here with your welcome.
Thank you, Michael. Thanks very much indeed. And great to join you, and good luck with Madison Alley. And it's purely, we share the same focus, the purely digital focus.
That's right, that's right. We'll turn to the next slide. And so, Madison Alley, as Sir Martin just indicated, we are a strategic capital and M&A advisory group, and as Sir Martin just suggested, we're specifically and have always exclusively been focused wholly on digital marketing, media, and advertising for the last 17 years since 2003. We're based in New York City with significant presence in Silicon Valley, and San Francisco, and San Diego. We are led by former CEOs and corporate development executives from the advertising and marketing industry with deep expertise in M&A and capital transactions. So with that, let us begin. We have an agenda here and discussion topics that we'll get started with. Okay, so to begin, it would be very helpful, Sir Martin, to have your perspective and have context. Given the global crisis that is underway and has been underway for, at least in the United States, for about 60 days or so, what is your view on the economic outlook, the timing and the pace of recovery? And also, if you could kind of give us a feel for how do you think this will come back to recovery in some sort of, what will be the new normal?
So I think the answer to that is, I'm not sure about whether any of the listeners or viewers will get much insight from this at the end of the day, because your guess is as good as my guess, or anybody on this video call, their guess is as good as anybody, because we really don't know. But we can take probably some educated guesses, and I guess I would be on the bullish side of the argument. I would be a bullish protagonist. I would be in the V-shaped school. or at the very least, the reverse of the square root sign, if everybody understands what that means, which is, we've already experienced an unprecedented downturn. I see the agency holdco executives are sort of suddenly woken up to the fact that this is unprecedented. Many compared it historically with what's happened at 2008 and the financial crisis, or the 9/11 crisis, or the 2001-2 dot-com bubble, or the 91-2 crisis, or indeed some things that none of you on this call would know about, which was the 1970 oil crisis, which I'm old enough to know something about. It's not like that. It's nearest as one can get to it. I think it's wartime. So this is a very different situation to any that we faced. It's not just a financial crisis, it's a healthcare crisis. It affects everybody, not equally. I mean, people often say this affects people equally, but clearly if you look at the demographic statistics, that's not just true.
Yeah.
Whether you're looking at America and you're looking at various sections, segments of the American population, or you're looking at the world, because what's happened to the north of the globe as opposed to the south is worrying a lot of people. I've heard in the last few days a lot of concerns, both from people, for example, in India and Brazil, about the impact of corona on them, as opposed to, let's say China, Western Europe, and the US. So what do I think the shape is? I think the shape is sort of V-shaped, or at the very least, so I'm in the sort of Goldman camp, if you like. Goldman have written one or two circulars, I think one a couple of days ago, which said that the market wasn't unconditional on it, may not test its recent lows, or they had a weak day today, and it will be a base from here. So I would see it as being sharp downturn. We had 23, 28 trading days, depending on which index you talk about, which were unprecedented in terms of the steepness of the decline. And then I see a flip back. Q2 will be a bloodbath. We're in the middle, not in the middle of it, we're at the beginnings of it. And Q2 and company results will be absolutely awful. And Q3, I think, will be a little bit better relatively. I mean, coming from a low base, I mean, if GDP or agency revenues are down 25% or whatever, the analysts are sort of forecasting. The Publicis yesterday wasn't prepared to give any guidance. I think very few of the holding companies are prepared to give any guidance, and probably rightly so, because genuine uncertainty, to be fair. But I would see a mild recovery from low levels in Q3, and then Q4 it gets better, and then into 2021 gets better. A bounce back maybe like we saw in 2010 as opposed to 2009. 2009 was brutal. But again, this is not like the financial crisis, so one doesn't know. But I would be in the slightly more bullish school, and maybe that's because S4 is purely digital, and we've not seen as yet. And we have a daily call, we have a Corona crisis group, a CCG group, as we call it, of 8 people in the company who get together every day and have a call about what's happened to our people, and happening to our people, what's happening to our clients. And probably the short-term focus is on finance and liquidity. We have no debt. We're net cash positive, even after having paid for the payments in relation to our mergers just recently of Circus and Firewood. So we're in a very good, strong balance sheet position, and liquidity is absolutely, cash is king, and liquidity is important. So we're very focused on that. So I think that's the shape. So I would be, and I'm looking to come out of lockdowns. I see Germany, just before we started, has announced the ending of a lockdown. I think it was in 3 weeks' time. So that's going to set the pulses racing in the big 5 in Europe, UK, France, Italy, and Germany, and Spain, and the pulses racing in the US as well, as to whether we can get the economy working again. I would expect lockdowns to be finished, harsh lockdowns, it'll be phased, harsh lockdowns to be finished maybe by the end of June, so second quarter.
Okay.
And then we start to prepare ourselves, I think, for a world that's going to look in a way similar to what we saw after 9/11. Who thought going through airports you would have the security we had? We'll go into buildings now, we'll have masks, we'll have temperature checks,
Right. Yep.
we'll have apps that say whether we're red, yellow, or green to go into meetings and physical distancing, etc. So I think that's the shape. I may be too optimistic. There's a school of saying this is all doom and gloom. And the reason I'm sort of relatively bullish, the president of the EU was on a call earlier today at the World Economic Forum where she referred to the 13 trillion that had been pumped into the European economy.
Yep.
Goodness knows what the total figure is for the world, but if you think that the worldwide GDP is about 72, 75 trillion, we're getting up to some very high numbers. I think the US is 19% of GDP that's being talked about.
Yeah.
So that's being pumped in. So the stimulus is huge, and I think the snapback will be good.
Yeah. So that's very interesting, and it was also helpful to see your thoughts on how the recovery will happen in terms of all the steps towards that. What about in terms of from marketers and advertisers? What steps do you think they'll be taking through the course of this year, to kind of step into their recovery?
Well, our revenues, our pro forma revenue is about $400 million. And we're seeking to double the size of S4 organically, ex acquisitions, or mergers as we call them, over the next 3 years. And people think that's very ambitious. We were up 33% in January, not as high in February, but still very strong. And March, we've not seen that much of an impact against our budgets.
Great.
Probably a little bit more impact on the programmatic side. The content side. Content is 70% of our business, and programmatic 30%. But not that steeper impact even on the programmatic side. So that's for the first quarter. Obviously, we'll see some impact as we go through April, May, and June, but not to the extent that we've seen, I think, with the holdcos, where the analysts are talking, as I said before, of revenues being down something like 25%. And we saw that reflected in Publicis' results for March, and they're rushing out the numbers for Q1. As far as the clients are concerned, I think that's the impact on the agencies. I think the clients, there are two buckets. Of our 400 million, tech is about 200 million, and that 200 million has remained pretty solid. I think there is some evidence of the big tech companies starting to move money out of H1 into H2, and that may be driven by the fact that we don't know how big a factor SMBs, small and medium-sized businesses, are in the context of the ad revenues of Google. If the digital market's 245, 250 out of billion, out of 550 or 600 billion. Google's about at 160, Facebook about 62. This is last year's numbers. Amazon about 20, TikTok about 7. Those are the four big ones that we know about. Alibaba and Tencent, obviously there. So those 6 platforms dominate digital advertising. The tech companies have really held their nerve, I think. They're moving money, for example, from sporting events. If they had sort of etched out big spending for Tokyo 2020 and Euro 2020 and the Premier League and baseball and basketball and golf and everything else, obviously that's been nixed. That will shift into later in the year or into next year, as we know. And that money, I think, was put to good in the sense of purpose-built programs, but doing good. One thing I want to say, Michael, is this sort of view in the ad industry. The client should spend during recessions of this nature, I think is nonsense. You can't, when companies are faced with an existential crisis that they may not survive Q2, you as their trusted advisor, you'll soon become untrusted, can't sit there and say, spend. You can say, let's move money into purpose programs of various sorts, as the tech companies are doing, but you can't say, you should flagrantly spend, because you may spend yourself out of existence. I do think, companies will be quite rightly judged by what they do in this recession.
Mhm.
And the data that you see that some of the companies quote about consumers think that companies should do good at some, because they should, but they should invest in equipment programs, protective clothing programs, vaccine development, sort of thing that Sanofi and GSK did yesterday, or that we saw with J&J announcing vaccine development. So these sort of things are the things they should be doing. The tech companies, I think, are starting to move money out of H1 into H2, maybe reflecting what we're seeing on the SMB front. So I think tech basically pretty solid, but some signs more recently of moving money into H2, not delaying and not spending. Clients often say to agencies, we're going to delay because they don't want to demotivate them. So they say delay because that's better than saying we'll cancel. I don't think it's this case. I think they will generally move it into H2. On the FMCG, retail, pharma side, less so pharma because obviously C19 is very much related to their business. But on the FMCG and retail side, we've seen a cutting of overall budgets, but a shift into digital, which will be permanent in my view.
Yep.
And I do think we'll come back to that maybe as to the permanent changes. But generally what we're seeing is an acceleration towards digital at the consumer side, on the media owner side, and finally on the enterprise side.
Okay, terrific. So it's all very insightful. So we're going to change a bit, and what would be very helpful is to get some really practical advice for a lot of agency leaders and marketing tech company executives who are listening here. So if we could just begin with, with now that we have your context and your perspective, leadership. What would you suggest to agency leaders and marketing tech companies and other executives in terms of what are effective forms and approaches to leadership in a time of crisis like this? Obviously, you've been through many different cycles of this.
Well, look, far be it from me to advise, because we all make terrible mistakes. So, the trick is to make fewer mistakes than the good decisions. So make fewer bad decisions than good decisions, and you win through the end. So I'm not going to pontificate on what you should or shouldn't do. I would just tell you what we've done.
Sure.
And what we've done is we formed this CCG, as we call it, the coronavirus crisis group. We prefaced that a long time ago, not with significant publicity, by the way, cutting the leadership. I say the leadership, the top 8 people in the company, have cut their compensation by 50%, and some by more, from April the 1st. We've done that for 6 months, and we've said that at the end of 6 months we will review the situation. So that was to demonstrate to the company that, and when we look at the holding companies, I think some of the holding companies have made obviously nominal changes. 20% for 3 months is nothing in the scheme of things. I mean, John Wren, I think, was quite significant yesterday, calling him out for, saying I'm going to cut my salary to 0 until September. And I think that sends a signal to the organization that senior management are taking this very, very seriously. And we immediately, when the lockdown started, and by the way, our people are digital natives. They're not digital first people. These are people who come from, Google and Yahoo and Salesforce. Many of them, they're not agency people. They come from production companies, and they are used to working at home because, our mantra is faster, better, cheaper. And faster means agility, which is a key attribute in our view needed in our industry and our clients. And that agility means you're 24/7, and it means you're always on, and you're working from home. So working from home, some of this crap I hear about, we've done wonderfully. I mean, it's amazing how we're working from home within a few weeks. It's complete nonsense, because all of our people are used to working flexibly. They work at clients on client locations, or they used to before the lockdowns, and they are intimately aware of the need on a 24/7 basis. So we did at the beginning, we cut compensation immediately about a month ago on essential spending. We didn't completely freeze hiring because we still have parts of our business that are growing very significantly. Animation, for example, robotic camera work, moving live experiences to online, just like we're doing here. All of these things meant repurposing content, and that gave us significant sort of new revenue streams. And we developed immediately programs for clients, both on the content and programmatic side, that were programs that they may have found useful to help. We're involved in, we've kept up the pitch activity, which is another, whether it's piece of advice. We're involved in 4 major things at the moment, which for us, given our size at 400 million, would be game changing if we were to be successful. And that's carried on both sort of virtually, in the virtual, online procedures, perhaps delayed a bit because of their online procedures, and they can't be as physical as they were before, but they carry on. We form the CCG group, as we call. We meet every day. Okay. We look at 3, the 8 of us. We meet. We talk about 3 major things: our people first, their health and well-being. We've had remarkably few cases. We've actually today we thought we were up at about 10 cases. We're down to probably about 5.
Okay, great.
1,500 people, which is great news, and our people in very good heart. So we talk about people. We talk about clients and the impact on clients and changes. We are seeing some clients ask for better payment terms. We are watching credit like a hawk. But the client programs, we're trying to develop alternative revenue streams, some of which I've alluded to already. And then the final area is the finances. And we look at our liquidity. We have no debt. We're net cash positive despite merger payments. We've got an unleveraged balance sheet, and we're in a very good position to take advantage of, I think, 3 things. We've already seen the holding companies come out now with blanket cuts. Just before I got on air with you, I hear McKinsey have cut compensation in the US by 10% for people over 90,000, I think it is. Anomaly had a cut of 10, they've taken it up to 17.5%. So we're starting to see the holdcos react in the true way. And I should know because I was on the side as you were before. And the trouble, Dentsu's decision to cut salaries by 10%, I think tells you what the holdcos are thinking about. They're thinking that their revenues will be down this year by about 10%, and that a 10% cut in headcount is the natural UPP with 100,000 people to cut out 10%, which will be 10,000 people. We will not do that at S4. We're of the view, we've already seen companies go into liquidation in our sectors. There will be more of that, and I'm not pleased about that. I'm not crowing about that. What I'm saying is that's a reality, good or bad. And as a result, there will be good people free, and there will be client opportunities free. And then thirdly, as you know, because you're in the business, there will be consultation opportunities. And we will continue to be sort of aggressive without impairing our balance sheet. So we will be doing a couple of things in the data and analytics area. We will be doing something in Germany. And we're looking at several other things, but not big in the context. And we're $1 billion market cap company, just under, and $400 million of revenue, going into COVID with EBITDA of about 85, 90 million after central company costs. So about 100 million before. So those are the dynamics, 2,500 people in 30 countries, as you said. We only want to be in one other country, which is Germany at the moment, 31. Geographically, listen, I'm still bullish, very bullish on North America and South America and Asia Pacific. Those are the 2 areas of the world. Less bullish on Western Europe because I think it's tough, and obviously bullish on Middle East and South Africa.
Okay, so that's all extremely helpful. So many of the, again, agency leaders and the audience here, they're looking to make similar decisions as you've been making. And a lot of these are very difficult decisions, and particularly difficult in this time because there's uncertainty. It's unclear, to what extent and the pace at which the rebound will happen. So what advice, if any, might you have for how do others decide on to what extent to cut, who to cut and retain, what costs to keep, and what to what to retain and what to cut at this point and at what pace?
Well, I think, Michael, it's extremely difficult. I mean, it's easy. I saw one of the questions that flashed up there was, should you make salary cuts? And I guess the question was, should you make salary cuts or people cuts? And I remember David Ogilvy many years ago saying he'd far rather cut the overall level of salaries, that everybody takes the pain.
Yeah.
So take a 10% cut across the board if it's the right thing to do, as opposed to cutting out 10% of the people. And I don't know really what the answer is. That all I know is, if I can think of in our own organization, in Asia Pacific, we've seen obviously in parts of Asia Pacific, pretty much all lockdowns.
Yeah.
And we have people who are in very short supply, who are not doing anything. And they may not be doing anything because they can't visit clients, they can't be on site, but they are in scarce supply. We've taken the position that we should hold on to those people and redeploy them.
Yeah.
We're not a big network, but we are in 30 countries, and redeploy them elsewhere. And we've managed to do that very successfully in a very short period of time. That may be because we're a smaller organization. And at times like this, the irony may be the SMBs may be more threatened, but they're much more agile and much more flexible than the aircraft carriers, right? So the motor torpedo analogy is the right analogy, or David and Goliath, if you like.
Yeah.
And that may be part of the answer. So it's very difficult to legislate for that. But all I would say is, I think this is going to be so sharp, and the snapback is going to be as quick. We're working in a warp speed. There was an analyst note yesterday talking about the warp speed, I think JP Morgan, of the market for the recovery in the index, by about 20% from the low. Everything is moving at warp speed. And I do think, and that may be one of the lessons from previous recessions, this last one, in 08, we saw a snapback. It took a year or so. But I've got to tell you, when I was at WPP, our US business was in shape in terms of the restructuring by the end of March of 09. So within sort of 90 days or so, because the thing hit in September and October, you went through to the end of the year, and 08 wasn't affected that much. It was 09 that took it in the teeth. And then 10. So what happened over an annual basis then may be happening on a quarterly basis now. And if you look at China, China is up and running to about 70 to 80%. You're talking, when you listen to people on the Business Council or elsewhere, it seems to be that the recovery in China in terms of productive capacity and activity is about 70 to 80% of what it was. And that's, within, if we say it started mid-December, so mid-March, that's a quarter. BCG had a very good analysis of a country-by-country lockdown analysis, forecasting that by the end of June, I think it was 20 countries, most of those countries would be out of lockdown, I think with the exception maybe of the US. And this is not, complete lockdown, but there'll be phased lockdowns out. So I think, again, I come back to, I think this Q2 is really tough. Q3 gets slightly better, Q4 better. And I think we will, this is maybe a shocking thing to say, but I think we will look back at this. And, we've got, 2 million people infected around the world, 125,000 deaths. So one death is unacceptable. But we will look back at this, and governments governments, businesses have overcooked their reaction because we were unprepared.
Yeah.
And this came out of left field. It was a black swan.
Yeah.
At the World Economic Forum, there were 2 sessions. I checked on this. There were 2 sessions on coronavirus. I think there were some people from Wuhan there, but all the news that came out during the World Economic Forum didn't come out from Davos. It came out from Wuhan. There were a couple of reports towards the end of January that were written. I think Niall Ferguson wrote a note. I think it's Green Mantle at around that time. So this came out of left field, and the reaction, quite rightly, is extreme. So I think you have to look at the snapback in that context.
Yeah. Okay. So that's actually very helpful. So in other words, you do believe, it sounds like, that the agencies and other companies should be prepared for a rebound and have resources set up and at least monitor that over the pace of Q2 and as this evolves and as we step into
I want to be in a position in sort of May, June to go on the offensive. Yeah.
Right. Exactly. Okay. Great. So what about clients? So what advice might you provide in terms of how to protect your accounts within, and also be strategically positioned or be positioned to grow? What should agencies and others be doing at this time to come out of this in better position, or at least protect themselves now and be in better position within their clients, as this starts to recover?
Well, again, it's difficult to. I think you've got to look at sort of two things really. Which sectors are going to be, if not permanently impaired for a significant period of time, and which sectors, which verticals have been less affected. I mean, Amazon hits an all-time high. Yeah. Netflix is close to an all-time high. I think it hit an all-time high. Yeah. I mean, you don't have to be an Einstein to figure this one out. Yeah. So there are segments. I think what encompasses all of this, and people may laugh when I say this, but faster, better, cheaper, or speed, quality, value. I mean, those are the 3 attributes that post-COVID-19 are going to become even more essential. So speed and agility, which I touched on. Better means understanding the ecosystem. So the 6 companies I mentioned, plus Apple and Microsoft. I think Apple has just come out with a cheaper phone today. Yeah, I saw a flash announcement about that. So Apple and Microsoft, Microsoft Teams obviously is another one of these Zoom-like, Skype-like, WebEx type things that we could all use. Sure. So I think you've got to look at the sectors. Yeah. I think there are 3 things in the second point. There are 3 major shifts that were taking place before COVID that have all been speeded up or will be speeded up by COVID, by C-19. Yep. The first is consumers. We're all locked at home. We're using communications like this, social media, video, streaming. We're using this. So consumers are going to become far more acquainted with it. Alan Jope who's CEO of Unilever, tells the story of how he was running Unilever in China. And after SARS, that was the sort of a climactic event. Yeah. That was the straw that broke the camel's back with the consumer about going online. C-19 will be the same. So we're educating our kids online. We're doing homeschooling. Everything is going to move even more rapidly. I was talking to somebody in India just a day or so ago who reflected all these changes. I mean, he has an app for all his people. He's got 1 million people, has 450,000 employees, 500,000 employees. And in India, has, I think it was 1.2 million, including people on the app, including dependents. They're all communicating with one another about C-19. So that's one. So consumers. Yeah. They're media owners. I'll give you a bizarre example. The Jewish Chronicle, bless it, founded in 1867, I think I'm right saying, ceased publication last week. Just at the tip of the iceberg, literally. Yeah. A number of media owners here in the UK
Yeah.
and elsewhere have ceased their print versions. They won't come back.
Yeah.
So analog media owners going to move to digital even faster than before. And then finally, and most significantly, enterprise managers who before C19 were unprepared to make the digital transformation decision because things were going okay. You know, pre C19 and the oil price spat between Saudi and Russia, you know, we had the G2 spat over trade and tariffs, but things were okay. It was slowing a bit, but things were okay. You eke out 3 or 4% top line growth. You were safe. You were CEO. CEO lasts on average in a listed, uncontrolled company about 5 years.
Yeah.
So you were there for 5 years and you were okay. You didn't want to disturb the status quo. Stand by. After this, you know, with the sort of bloodbath we're seeing, you look at the banks, you know, profits down by half because of loan provisions. They're going to institute these digital transformation programs much more aggressively after or during than before, because all bets are off now. You know, the results are, so taking a hit on a non-cash balance sheet write-off is not such a orgasmic problem as it was before.
Yeah, great. Okay, so let's turn now. You mentioned some interesting points, particularly about the industry. So we're going to bring up some slides here and then look at the industry. So first, what we have here is a slide that just, you know, for sake of perspective, a relative perspective of, this is a 2019 look of how digital ad spend in the US is proportioned. And as you see here, you know, retail comprises about 22% of that, automotive and financial services are second at, you know, about 12%. And then you have telecom. And then importantly, travel only comprises 8%, so under 10% of the US digital ad spend, because that looks like the part that's been hit the most. So with this in context,
retail, retail, Michael, you know, is pretty big. It's 22%.
Exactly.
And that has been hit. I mean, there have been, you know, differences there, and retail can cover digital or online retail as well, but retail's been hit. Automotive has been hit. So you're talking about retail, automotive, financial services, you know, big opportunities there. I mean, being hit, but big opportunities hit on the SMB loan provision side. But, you know, for transmission payments, electronic payments, big opportunities. Telecoms, very interestingly, you know, they were becoming utilities. They've got a big surge come as a result of it. CPG, it varies. You know, Unilever says we're not going to be spending money on ice cream or food service, but we're going to spend money on cleaning and other areas of their business. Travel obviously hit. Computing, consumer electronics, big opportunities. Media, you know, and entertainment hit. Healthcare and pharma, obviously big opportunities, but interestingly there, you're only saying only 3%. So, you know, most of the stuff on the right-hand side, the retail, automotive, you're talking about what, 34, 36, 40, it's almost half of the pie chart is under pressure in one way or another, maybe less so financial services. So certainly well over a third. And then you add in travel, which is another 8%. So you're up to about 40%.
So we'll look at the next slide here, which supports many of what you're saying. So this is you know, really a fascinating chart. You know, we think because you also see the dramatic spikes, and this is only over, you know, about a 60-day period. So you can see there's, you know, within a matter of days, you know, if you look at the you know, the travel, you know, it's 50% below. These are the hotels and the airlines, you know, in a 60-day period, and in fact, within a couple days, dropped. Something from a little close to maybe 37% decline to close to 60% just in a matter of days. So it's pretty remarkable. So these are the
well, I think on that chart, you know, pharma you can understand. Just going down retail, it's mixed because some get hit. You know, for example, in India, you know, with the lockdown, I would imagine that, and this has great political significance. The wholesale and retail, you know, there's tremendous fragmentation. You know, that would be something I think that Modi would be very focused on. CPG, you know, the obvious reason. FANG is interesting to me. That should be at the top of the chart. I think one of the things that's really important to understand particularly after Google took the decision, or is taking the decision about nixing third-party cookies in 2 years. And of course, Apple have changed their phones immediately on third-party cookies. This is a very significant decision, and a number of clients are very concerned about the fact that third-party cookies will not be available to them in the future. They're very focused on developing their first-party data sources with help from Apple and Amazon and Google and Facebook and others for signals. But this is going to drive, I mean, this is going to be very important for the platforms. TikTok, there was an article on Breaking Views a day or so ago about TikTok and the data that it has managed to accumulate in the last 4 to 5 weeks or last quarter in China. It's huge. And their understanding of consumers at Amazon, at Google, at Facebook, at Apple, at TikTok, at Alibaba, at Tencent, is going to ramp up enormously. And that third-party cookie decision has enormous implications. And that's why our data and analytics practice is doing so well. And that's why even in this difficult time, we're seeing tremendous interest in data and analytics. But I would put the FANG and the telecoms, further up your list. Energy was obviously hit by the oil price.
Sure.
Banks were hit by the provisions they'd have to make. Although they seem, you look at the JP Morgan balance sheet, it looks rock solid.
Yeah. Okay, great. So let's turn to some of the points that you mentioned in terms of, so in this new environment and the new reality, which will obviously unfold, and you talked a bit about some particular technologies or even behaviors, consumer behaviors that will be enabled and accelerated, through the course of this, this new remote, at home as it starts to unfold. So what are, you talked about some of the things like even data analytics and remote engagement and remote experiences. So what are areas that you think will be enabled by this new experience for all of us? And for that matter, which do you think will are there challenges ahead? For example, like experiential, and so where do you think the opportunities lie?
Well, you've got to look at this dynamically, and it may well be that the immediate impact, the short-term impact, will be very different to the medium and long-term. For example, I will be doing more of this stuff, even if I think the French have just extended their lockdown for another 3 weeks, and people are saying that the British will do at least that, maybe longer. But let's say that by the middle of May, we're allowed to return to our offices. Work from offices with a mask. I see Cuomo is saying everybody in New York's got to wear a mask by Friday. So, masks, checking in at the door, temperature checks, whatever it is we have to do. So rather like airports, as I said before. Immediately, I'm going to travel less. I'm going to communicate more online. I'm going to buy more online. I'm going to educate myself, kids, whatever, grandchildren online. So travel online. So if I'm Duncan Painter at Essential and I'm looking at reinstituting Cannes Lion, I probably don't want to make it a virtual experience, but how can I make it a more acceptable physical experience? Or maybe I mix the two. Maybe I'm going to have people coming to Cannes, or I think they should do it somewhere else at a different time of the year, but maybe I do it somewhere, and then I have a virtual one as well, because I have two segments of the market. So I think those sort of things are going to be affected very significantly. And I think, I've outlined what I think is going to happen with consumers, media owners, and digital transformation. I think the faster, better. I come back to the faster, better, cheaper stuff. Let's turn on to the cheaper thing. I think it was very interesting what Apple just did, because I think coming out of COVID-19, consumers will want functionality, and they'll want it delivered technologically superbly.
Yeah.
And efficiently. Let's not call it cheaper or ZBB or anything like that. Let's just talk about the need to be more efficient.
Yeah.
Obviously, coming out of C19, purpose, or rather, let me put it a different way. Long-term thinking will become even more important, because I think when we talk about purpose, if all of us thought about things much more long-term,
right,
everything around purpose would fit neatly into shape. I mean, because the stakeholder theory, Klaus Schwab's stakeholder theory from the forum from many years ago, is really about taking the long-term view. So I think after C19, I think probably people will be a little bit more philosophical about the long-term view and the need for purpose built into what we do.
And even potentially like social
not purpose for profit, but purpose for doing good. And doing good is good in the long term. So, I mean, if you're focused on the long term, doing good. So I think those are the things that will come. But you know, to my mind, travel, you know, I will look at travel differently. I'm going to look at education differently. I'm going to look at communication differently. I'm going to look at shopping differently. I'm going to look at office space. I've already had discussions internally at S4, and I've talked to clients who've already started to look at, we've already started to sort of terminate leases and things, because a lot of our people, having gone through the experience that they've gone through, prefer having more flexibility in their life, prefer, would you believe it, to be, you know, more family time, but they prefer more flexibility, and we're used to that. So we've already had discussions internally, you know, of our costs. So our biggest investment is in people. So the whole co's, ourselves, everybody else, about 60% of their net revenues are invested in people. The second biggest cost is property, 6, 7, 9%. WeWorks, Adam Newman was onto the right idea. I want to give you more, maybe the execution was slightly wrong, but the idea was to give you more flexibility. You know, great for an agency. You win a piece of business, you expand your WeWorks presence. You lose a piece of business, you can come out of it, you have more flexibility. I think that one of the results of this is going to be people going to look at their real estate costs much more carefully. They'll have much more, you know, we have an embedded model. We go from in-housing to outsourcing. In the middle, there's an embedded model where we're living and working on the client's premises. One of our guys wrote to me and said, look, I've never spent any time in our office in San Francisco. I've been at the client all the time. Why do we need the office space we have? It's a needless cost, and it can be quite lavish. I mean, people should have, you know, good premises and good offices and that. I'm not saying it should be that parsimonious about it, but I think there's a balance here. So I think we're going to see big changes there. And of course, you know, retail space. If you've shifted a large amounts of your business to online, what about retail space? What are you going to do there? So these are major changes, but basically it'll accelerate. I think what C19 does accelerate the trends that we're already.
Great. Okay. So just shifting to topic of M&A and transactions. How do you think that strategic transactions will be affected in terms of the pace of which, you know, what are M&A buyers, you know, how are they going to, you know, approach strategic M&A opportunities throughout the course of this year? How will valuations and structures be impacted? And how do you think that'll take shape?
Well, you know, I hope as a buyer, looking for merger partners, you know, we look for people who are going to buy into our concept of building a new age, new era, new media model. We're not interested in people who want to sell out. We want to be interested in people who are going to sell in or buy into our concept. I hope the prices will fall. I have to say, I don't think they will. So following what I said about, you know, the reverse of the opposite of a square root sign, or the reverse of a square root sign, or V, I think, you know, I haven't detected that valuations have come down. I think, you know, I looked at Silver Lake putting participating in the $1 billion refi of Airbnb, and saying at the same time they were going to raise $16 billion in a new fund. Bain Capital came out with a number last week, $832 billion, I think it was, of dry powder, free equity, unlevered equity. I mean, the credit markets may be shut, but they'll open again.
Yeah.
You may not be able to gear it up 5 or 6 times, but just think about that 800, call it a trillion, levered 2 or 3 times. So you're talking about $2, $3, $4 trillion that can be dumped by PE into. So I have a feeling that you may see a correction in valuations, but it's not going to be much. And in our own industry, Accenture, I don't understand why, but they continue to hoover up at a rapid rate. If Deloitte's split off Deloitte Digital, I'm told by people at Deloitte they're bigger than Accenture, that Deloitte Digital, so that would be another $100 billion Goliath that you'd have to deal with. That would be another Hoover. And I should say Dyson in these days. My sense is, Michael, that any valuation drop will be pretty short-lived, because I think there's a lot of liquidity about. I mean, you see some of these equity raises here in London, S&P and others, heavily oversubscribed. So there's a lot of willingness. I mean, it's true that the share prices have come back. SSP was down to about 1/3 of where it was. And everybody said, well, the equity went better. Well, it's almost like a distressed rights issue. But I think the market is still going to be pretty strong. So I come back to the 3 things I mentioned. A number of companies are going to go fat. There'll be good people available. There'll be client relationships that will be fractured or movable. And then thirdly, there will be consolidation opportunities. But I think fundamentally, the strong get stronger. So the strong companies, whether they be big, medium-sized, or small, will have very significant opportunities. Not just M&A. I mean, Google and Amazon and Facebook will have big data opportunities as a result of this, and digital transformation opportunities. But I think from an M&A point of view, any let-up, I'd be prepared to bet that any let-up would be short-lived, and I will be. Well, we still are, as I said to you. We've got a couple of data analytics, a thing in Germany, and we've got a lot of other things that we're looking at. But I don't want for the short term to medium term to jeopardize the balance sheet. I think cash is king, as I said, and maintaining liquidity, and you're bound to have accidents at this time. And so you have to be careful. You have to be prepared.
So that's in line with what we've been seeing, where strategic, particularly in digital marketing, the capabilities are still needed, and so there's still a high impetus for strategic M&A opportunities. But that said, there's a bit of more of a cautious approach and a bit more conservative approach, and also more visibility that wants to be seen, over the next kind of few months or quarters to see how things play out. But obviously,
I think
the strategic end is there.
I mean, I may be wrong on the timing, and I may be too early. But I'd be looking, to do stuff after Q2, because I think after Q2 you can come out of the traps fast. The competition will be dozy. And it will be easier to move. And I think, and the other thing is maintaining the fabric of the business. I was talking to a client earlier in the week, one of our biggest clients, and he kept on saying, we want to maintain the fabric of what we've got with you and indeed with others. And I think the mistake always that is made, and I would say I'd admit to doing this at WPP, is that you just like governments, I think, overreacted in a way to C-19 because they were forced to. They did the right thing. Don't get me wrong. They did the right thing, but they were forced to because it was a black swan. Same thing happens here. Agencies are the same. The stuff that we're seeing today. Publicis yesterday. You've got Omnicom. You know, for John Wren to write the note that he does. I mean, he's not out there up front all the time, but I think that was pretty eye-opening. I mean, they must have seen things. And then Publicis, you know, on March the 18th, they confirmed to analysts they were going to pay a full dividend. For 2019 in 2020. And then by yesterday, they changed their minds, and it was only half, and they were postponing it for 3 months. In the scheme of things, if you look at it, you know, they claim they have 4.7 billion or something of cash equivalents or revolvers or whatever. I mean, in the scheme of things, it was nothing. So why did they suddenly reverse course, rush out their announcement? It smelled a little bit of Jimmy Breslin's The Gang That Couldn't Shoot Straight, but maybe I'm being unkind. Or Fred Carno's Circus is what my dad used to call it. But, you know, listen, we all make mistakes, and maybe that's that was another one of them.
So I'm conscious, you know, one, in respect of your time, there are a couple of questions, if you wouldn't mind, maybe we'll just ask a couple of questions here.
We'll try.
So the first one is by Amy Buckner Chowdhury, who's the CEO of AnswerLab. And what Amy is asking is, what range of economic scenarios are your portfolio companies using in strategic planning, the percentage change in both the upside and the downside?
Well, we don't have a portfolio. So we have 4 principles: digital, purely digital, the holy trinity of data, content, programmatic, faster, better, cheaper, and a unitary company. So when we meet, the 8 of us, we're meeting as one company. And we've looked at multiple downsides. And we don't look at it by company by company. Well, obviously we look at it by location and region, etc. But we've looked at we're just producing our annual results, and there's a stipulation by the FCA here in the UK that in fact they advised companies not to issue their results until they had stress tested or looked at all the possible scenarios sort of in the course of C19. So the answer is we've looked at various downsides on revenues. Now, you've got to remember that, you know, we're growing pre-COVID at 40-45%, depending on whether you're looking at gross or net on a like-for-like basis, revenues. And going into COVID, we were up 33%, and in February, a similar figure. So we were still strongly up, and I think in March we'll still be up strongly. And so we haven't really hit. So we're looking at numbers, and we will vary the revenue numbers, we'll vary the cost. You know, our model can look at just touching non-essential, what we would call non-essential costs, non-client costs, for example, taking out all travel. I mean, most travel has gone anyway. Obviously, entertainment and associated expenses, shows, and everything else. All the things that the holdcos, our model does that. It looks at, you know, what it can theoretically look at what we can do in terms of adapting number of people in the business, salaries, or whatever it is. The sort of scenarios in the traditional, underlying traditional part of the business that the analysts are looking at is somewhere around 10 to 15% revenue drop for 2020 alone, with a heavier drop. It looks from the Publicis numbers as though parts of their business dropped by 25% in March. So a number of the analysts today and coming days are sort of describing a scenario where Q2 could be down by 25, 30, 35%, which is horrendous. I mean, that, you know, all of the focus is the top line. Can you imagine what's happening to the bottom line? I mean, if they hadn't rejigged their costs, and of course, it's very much easier to rejig your costs in America than it is in Europe. And, you know, many of the companies we're talking about, the traditional companies, their heartland, to some extent it's America, but it's also Western Europe. And I said to you, when 2009, we'd restructured our business at WPP by the end of March. of '09, having gone into the recession, let's say in October, November of '08, so 6 months, let's call it. In Europe, Western Europe, you're doing it 2 or 3 years later. It's going to be very difficult in France, in Germany, in Italy, and Spain. That's why when I saw that headline about Germany coming out of lockdown on a modified basis, I guess in 3 weeks, I thought that was really interesting, because that's important. That's really important. Germany is the strong man of Europe, and that's important.
So I'm going to ask one last final question, and then in respect of your time and others here, we'll be glad to we'll let you go. So Nick Paul, who's the president and founder of O'Keefe Reinhard Paul and Paul, the agency that's based in Chicago, asks, what is the most important decision you can make now to position your agency for prosperity coming out of pandemic?
Well, look, your biggest investment, and it's not a cost, it's an investment, is in people. So, it may sound trite, but it is fundamental. I mean, the most important decision is on your people. Right. And if you're faced, with the hard decisions that, clients have pulled business, and you're facing an April, a May and June that is bleak, I would say protection of your key assets, which are not buildings, they're not pieces of machinery, they're not offices, they're not cars, right? They're people. At the end of the day, it's obvious, and that is the thing. So preserving that, protecting that, it's probably easier for us because we've got 2,000. I mean, one of the things I didn't say, I communicate regularly. We have regular calls in addition to the CCG, which meets every day. We have, I send out every week a note on where we are to every individual in the company and ask them feedback. I mean, I just leave with one story on why the importance of people. I was doing something with HBS on crisis, and the case study they took is the Chilean mining crisis. And the guy who was running from Codelco, which is the state, this was a private company that had the 33 mines trapped 700 meters underground and under impenetrable rock and impossible to drill. And the great story there is that the guy from Codelco who was running the drilling, and they got to a stage, I think it was after about 16 or 17 days, I think it lasted 70 days, I remember rightly. And then when they found them, after 17 days, they discovered a way of drilling through this impenetrable rock. And the idea came from a 23-year-old engineer, Chilean engineer, who said to the guy running the whole project from Codelco, have you thought about this? And the guy running it, Codelco guy, had the wisdom to listen to the guy. Right, sure. And B, say, oh, I think you've got an idea there, and implement it. And they found a way of drilling through the rock. They drilled this very small borehole through, and then they widened it. Sure. And eventually they managed to bring up all 33 safe and well. So it underlines the importance to me of your biggest asset if you're in the agency business or consulting business. We prefer to call ourselves consulting business. It's the people, and it's maintaining that fabric. Everything else, I would say, forget about. Yeah. After all, the reason why clients come to you, it's for the people and nothing else. Yeah. Well, that's terrific. And obviously, regardless of where everyone's working remotely or together, at the end of the day, your culture and your team and how you can, work and service clients is what matters more than anything. Yeah, I just think, just to answer the question, one of the things that I've found remarkable about S4 in this very difficult period is the energy and commitment. And, I think that's the difference between founders. I mean, a lot of people on this call will be founders. A lot of these people will be people who call themselves entrepreneurs, which means risk-taking, which means you put your money where your mouth is. Sure. People whose money is invested in the business. Yeah. I've often said founding a business is like or nearest a man can come to giving birth, not physically but mentally.
Yeah.
And I really think at times like this you see that. So
Yeah.
the founder commitment,
Yeah.
and the entrepreneur's commitment is totally different
Mm-hmm.
to the manager's commitment.
Right.
You know, and that's not to say that managers are wrong or bad or whatever.
Yeah.
It's just to them it tends to be more of a job, and there is no emotional commitment.
Right.
You know, it's a job.
They have everything at stake. Right. Everything at stake, and they have the life and
Bill
yeah.
Shankly, the famous Liverpool manager, a football club man. I mentioned Liverpool again now that Jurgen Klopp has got to where he is. Used to say, football is not a matter of life and death. It's more important than that. So that's how an entrepreneur or founder thinks about their business. It's personal. It's personal.
Yeah. Terrific. Well,
Okay.
yeah, I think that's an excellent way to end this. So, you know, we're very grateful and appreciative of you taking the time, particularly in a moment like this where your sound advice and experience and insight is.
Well, I don't know about that, Michael. You should be in the ad business. You're a schmoozer, but I hope what we talked about helps people.
Yeah.
And I wish everybody good luck and good fortune, and stay safe and stay healthy, and your families and your friends and their families. So we'll get through this together.
Yeah, and sincerely, we do appreciate it, and I do believe that you know, a lot of this insight is very helpful as people are making very difficult decisions in you know, how to.
And anybody wants to email me, Michael Martin at s4capital.com.
Okay. Well, thanks very much,
Okay.
Sir Martin. It's really been a pleasure and a delight.
God bless.
Stay
Keep well.
safe.
Keep safe. Keep safe. Bye-bye.
Okay, take care. Cheers.